Okay. Good afternoon, everybody. I'm super excited for y'all to be watching us today discussing Delaware Statutory Trust. I'm super excited to have with me Brian Evans. He's been a CPA for over 30 years. He is the owner of Madrona Financial Services and Bauer Evans, Inc., which is a CPA firm. He serves as the Chief Investment Officer, Lead Planner, and Senior Portfolio Manager. He hosts a weekly radio show and is a nationally published author and has been a regular guest on CNBC and Fox Television. This guy is the real deal. He's from Lake Stevens, Washington. So he is, it is morning time where he is for sure. So good morning, Brian. Thanks again.
Good morning.
His firm has over $400 million under management. He is a brilliant individual. I'm thrilled to have him on here to discuss Delaware Statutory Trust and how they could fit in with your real estate strategies. My name is Reid Mathews. I'm with Berry Financial. We've got about 3,000 clients and have $400 million under management as well with Berry Financial Group. My father-in-law started it over 30 years ago. Let's dive into some of these things. Of course, when you're talking investments, specifically private positions like DSTs, you do have to be an accredited investor, which means you've got to have income the last 2 years that's exceeded $200,000 or $300,000 jointly for the prior 2 years, as well as have a net worth of over $1 million, not including your residence. So let's get that out of the way. The agenda for today, I'm really excited about what we're going to discuss, because we're going to discuss, if you're tired of being a landlord, what could be a great exit strategy. Some of the biggest cons that I've personally heard of, as well as Brian will share some examples, are people tired of being a landlord, but they don't want to sell due to taxes, due to some different things. We're going to talk about how you can defer those capital gain taxes and literally eliminate them. Really cool strategies for that. What happens after the sale of real estate and where it may make sense to have a Delaware Statutory Trust. The basics of Section 1031 and 1033s and DSTs. A process overview. We'll talk about from the start to the finish. It is a longer term process, but just like real estate closings in general are longer term. And then next steps to working with us as your advisor if a Delaware Statutory Trust is right for you or for your clients. So we're going to go through a process walkthrough. We're going to answer some frequently asked questions, as this is a very detailed process that not many people know about, and as well as some of the next steps. So Brian, jump right in. You tell us a little bit about how long you've been doing DSTs, as well as walk through the process, if you will.
Yeah, and before I do, I did want to mention on the accredited investor designation, a lot of people ask a couple questions. One is, do I have to make that amount of money and have a net worth of over $1 million? No, it's either or. So as long as your net worth is over $1 million, not including your principal residence, but it can include the rentals that you own. So a lot of people, that is where their net worth is. So just want to clear that up.
Perfect.
So, yeah, I wrote a book back in 2004 talking about how REITs could be a really good, real estate investment trust could be a really good piece of investment portfolio. And I've been doing CPA. Our firm does thousands of returns. I've got 25 employees between the two companies. And it's a very common thing that we're working with people with real estate, either businesses or real estate or both, because that's where most people got their value, their worth. And so been doing it for a number of years. I had clients coming to me for, gee, I want to sell, I'm getting older, because most of the, 40% of all real estate in the United States is investment real estate. And so we're talking anything but your principal residence and your vacation home. It could be, here's another question I get asked, well, what qualifies for 1031 exchange? It could be raw land, a rental house, a fourplex, apartment building, a winery, oil and mineral rights, industrial park. It could be a long-term lease of an industrial park. I've seen that one. So there's lots of different things that it's investment real estate. That's what it is. So as the people that own that, they're closer to my age than yours, Reid. And so people closer to my age are thinking about retirement strategies. And they're thinking, oh, my friends have a lot of time and freedom, and I don't, because I'm still kind of tied down. Even if you have a property manager, you might, we'll talk about reasons why you would do it. But been doing this for a number of years. The most important thing with real estate is location, type of real estate, understanding how it's going to react in recessionary times, post-coronavirus topics. We can hit all of those.
Okay, awesome. So you've been doing it for quite some time, and you started out as a CPA, of course. So you saw a lot of people have properties, but like you said, come in and thinking about retiring. But to be a manager of your own properties is pretty time consuming, right?
It is, and there's a lot of other things that go on with that. Is that even if you like being a landlord, maybe you're getting on in years and your spouse might be stuck with it if something happens to you. Maybe your properties are getting older and have a lot of deferred maintenance. So when I ask somebody, what's your cash flow on it? They'll go 6-7%. Really? After expenses? No, 2. After repairs? Oh yeah, last year I spent 30 grand on a roof. 2 years before that, I had somebody move out who trashed it. Oh gee, I'm actually not making any money at all. Yeah. So deferred maintenance is a big deal. Having freedom. I mean, some people, they're spending all their time doing that. They're close to 80 years old. And I remind them, do you need more money? Because they're worth, millions of dollars. Do you need more money or do you need more freedom and time? And I'm like, oh yeah, that's a good point. Some people in my area realize there's some really bad landlord laws being passed. We actually have socialists. That is how they ran on our Seattle City Council. And you do not want to be a landlord in Seattle right now. They want your property and they're not going to let you, do anything with it. And people are just going, you know what? It's kind of, maybe the market's topped out. Maybe I want better diversity. I mean, there's a million reasons to want a DST. I did want to spend a moment to talk about why you would not want a DST. This is probably the most critical part of this. Let's say that you inherited some property and you think you got to do a DST. And you say, I want to do a DST, I'll say, well, how much is your gain? You got to step up in basis. If the gain isn't much, don't do one. There's other things you should do instead. Let's say you're 40 years old and you're a real estate developer and you're making bank, you're getting rich off of real estate. Keep doing that, because DSTs are a retirement strategy for a landlord, a stay rich strategy, not a get rich strategy. And so if you're still in the game, stay in the game. And when you're ready to retire, then do the DST. And finally, it's liquidity. If you sell your property and you're telling me, I don't want to pay the tax, but I need the money because I absolutely need to buy myself a Bugatti in a year or two. Well, they aren't very liquid, so don't do it. So if you need all of the principal, then don't do a DST.
Okay, beautiful. So just like everything, there's good and bad. And really the process, like Brian said, the first thing first is you got to have a desire to sell the property. And why would you want to sell? All those reasons we just mentioned. You got some serious costs coming up with deferred maintenance. You're tired of being a landlord. Once you have the desire to sell, you got to list the property. That's where a great realtor comes into play. So there's a lot of great realtors out there, but the realtor has to be involved to sell the property, which is a great thing. So for realtors that have clients who want to sell the property, but they don't want to get killed by taxes, so they won't sell, then that's still a great position to look at a DST to get that tax deferral. Then a couple weeks out, you contact a financial advisor who then we secure the monies with the intermediary. Then about 1 to 2 weeks prior to closing, we work with Brian at Madrona Financial to vet these DST sponsors, which have multiple properties, which Brian, I'll let you talk to in just a moment. We do all the paperwork. Partnering with Brian does all the paperwork. So once those monies come to the DST, then you start getting your monthly checks, just like you were. You still have rental property in your portfolio. And Brian, let's keep moving to the next slide, because I know there's a lot of great things to discuss. Some of the pros. If you're tired of being a landlord, a DST may be a great option. You eventually want to pass your legacy assets income tax-free using the step up in basis. Brian, what really is the step up in basis? How does that work?
Yeah, a lot of people don't know what this is. A step up in basis applies to most everything except for retirement plan assets and IRAs and annuities. So if you have appreciated property, let's say you paid $100,000 for some real estate and you depreciated it down to 20,000. If you sell it and let's say it's worth $1,020,000 and you sell it, you got $1 million taxable gain. So you got to pay tax on it. If you pass away and your heirs inherit it, then the new cost basis is no longer the 20,000. It's the fair market value at the date of death. So $1,020,000 in this example. So if you sell $1,020,000 place and your cost base is $1,020,000, there's no income tax, no depreciation recapture, and no capital gains whatsoever. So most of my older clients do not want to lose 20 to 25% of all of the value of their real estate upon passing or during their lifetime. They'd rather pass it on to their heirs or spouse or heirs, capital gains tax-free and depreciation recapture tax-free.
Wow, it's absolutely brilliant, because at the end of the day, it's not about how much money you make, it's how much money you keep. And most people want to keep the money in the family and not the IRS. Some of the other things, if the local real estate market's reached a high and the timing to sell feels right for you, your cash flow's low compared to that offered by a DST. We'll talk a little bit about that too. Your property's aging, and so are you, and so am I, and future repairs could be high, and you don't want to pass away and leave a management burden to your spouse or children. Brian, you've seen a lot of people with a lot of things, and typically, what do you see as, how do you feel like the spouse or children react when they get left with a property, but they don't know anything about real estate?
Well, that's funny you ask that, because I get that a lot, because people, well, I've had this real estate, I worked on it my whole life. I'm kind of sentimental about it. I want to pass on that legacy to my kids. I said, well, that's great. Tell me about your kids. And we'll talk, and I go, well, let me sum it up. You got 3 kids. The younger brother thinks the older brother's an idiot. The older brother thinks he should manage it, and the middle sister wants to sell it. Does that about sum it up? And they go, yeah, that's about right.
Oh,
how do you think that's going to go after you're gone? Not so good. So how about you pass them real estate where they can make their own decision on their own share through the DST. And so that can solve a lot of problems.
Wow, that's a big deal. Some of the cons, like Brian mentioned earlier, lack of liquidity, which you could argue real estate's illiquid anyways. If you enjoy being a landlord, and it's not a get-rich strategy, but a stay-rich strategy. So just like Brian said earlier, that's a big deal. If you are in the game and you like going to the properties, you like calling the contractors, you think you are doing it the best, and you probably are because you enjoy that stuff, then you keep on keeping on. It's for the people that are tired of being a landlord and want a different option, and as well as for if you got some boot with the 1031 exchange with Brian, I know you like the word boot right there.
Yeah.
So 1031 exchange overview. What is a 1031 exchange? How do you define that in CPA terminology and layman terms?
Yeah, it's the ability to sell your investment property, and you have a time period, 45 days, to find a replacement property and invest in that within 180 total days. So some people have done 1031 exchanges. They've sold a rental house in one city and bought another rental house in another. You can buy anything. You could sell, again, a farm and buy 4plexes to replace it. But the problem is, a couple problems with the old 1031 exchange is that the people I'm talking to that want to retire, they say, well, if I sell a property to buy another one, how did that solve anything? I'm still in the same boat. So that's the big one there. The second one is, in my area, prices went up so fast. One of my offices is about a half a mile away from the 2 richest people in the world, Gates and Bezos. And so prices are really high, and they're just saying, well, I can't find a good deal. I can't find anything to get into. If I sell my property, I only have 45 days. And in our market, a good property might have 30 offers, so they wouldn't get it done anyway. So DST is a Section 1031 exchange. It's just that instead of trying to find another property that you have to manage, we find a property you don't have to manage. It's already ready to be purchased and identified in the 45 days, and you can do it immediately. So it's already inventory that's available. You just would own a fractional share of the property instead of the whole thing.
Awesome. And just to repeat, you said your office was a half a mile away from Bill Gates and Jeff Bezos.
Yeah, one of my offices, yeah.
Please tell me they are your clients.
They are not my clients. They were. We would not be talking right now, Reid.
Okay.
I'd be on my island because there's some rich people around here.
Oh, man.
Yeah, we have an interesting area. We used to be all Boeing, and then it was Amazon and Microsoft and Starbucks and Costco and, you know, on and on and on. So a lot of entrepreneurs here because it rains a lot. This is my theory. It rains so much here, people are inside on their computers instead of outside playing baseball. So we have a lot of nerds up here. So
okay. Hey, that makes a lot of sense. That really does. How long, a little bit about the history of 1031 exchanges.
yeah, it's been around the tax code for 99 years.
Oh,
actually.
my.
So a long time. People ask me, is that going to go away? Well, sure, it could. However, it's been there 99 years, so I feel pretty good about how long it's going to be around. It got codified with the Starker case, Starker exchanges. You maybe heard that term. And the term like-kind exchange, I do not like, because I don't know how like a oil well is to a fourplex or a winery is to an apartment building, but they are considered like-kind as it relates to 1031 exchanges. The like is just investment real estate for investment real estate.
Oh, wow. Yeah, that's very interesting. And what types of real estate qualify? You mentioned it. You said really anything from fourplexes, oil properties, single family homes, big multifamilies, commercial real estate, different office rentals, right?
Yeah. Yeah, pretty much anything except for your principal residence and vacation homes.
Okay.
And even vacation homes can qualify if you don't use them more than 2 weeks a year.
Okay. I actually just passed my 4th exam of CFP, my
Wow.
CFP exam, and it was income taxation. And I learned about that, the 2-week rule.
That's a tough one.
I know, it was a grinder. I feel like I was trying to get my CPA like you, man.
Yeah.
What are the 45 and 180-day rules? Could you go over those again briefly?
Yeah, if you sell your property today, you've got, and the money goes to the qualified intermediary, then you have 45 days. If it doesn't, I got a call once. Yeah, I've been meaning to call you. I sold my property for $3.5 million. I'm ready to do a DST and not pay $600,000 in tax. And I said, where's the money? I was in my bank account, ready to go. I said, nope. We're done. You didn't do it right. It has to be at the qualified intermediary. It can't touch your bank account. So if it goes to the qualified intermediary, which is somebody we hire, probably costs you $1,200 per exchange, you've got 45 days from the date of sale to identify what you're going to buy in its place. So some people go out, well, I'm going to go try and buy a property, and they look around, they make some offers, get some inspections. They go, oh, this is not going to work. It's day 41. I can't find a property in 4 more days. And then they'll call me and say, can I get a DST at the last minute? I'll say, sure, they're available. But you only have 45 days. If you go 46 days and you finally find the property of your investment dreams, too late. It has to be within 45 days. And then once you've identified it, you have to close it within a full 6-month period from the date of your original sale of your property.
Wow. Do you feel like they, cause that's that's run and gun. You better be Johnny on the spot and stuff's got to go smoothly. Do you feel like that the IRS made it that short window due to the fact that, you know, the 1031 exchange is very quick and they want to stir people kind of not to do that so they get their tax money?
Bingo.
Ooh, the IRS is coming for you, isn't it? Internal Revenue Service. They want revenue.
Yeah.
Um, Definition of like-kind exchanges. I know you talked about that. Do REITs, real estate investment trusts, do they qualify for 1031 treatment?
No, they do not, nor do partnerships, LLCs, any other form of ownership. So the only way that you can do a 1031 exchange where you're not the property manager and in charge of it, the active landlord, the only way you can do it is through a Delaware Statutory Trust.
Wow. So a Delaware Statutory Trust is really kind of like the unicorn of 1031 exchanges.
Yeah. And it's not well known, as you mentioned earlier.
How would you define a qualified intermediary?
A qualified intermediary usually works with a law firm or a title company, and it's just a designation. They're the transfer agent, essentially. So 1031 exchanges, you're not really trading one property for another. You're buying a completely different property, but they allow you to do the paperwork in such a way where as long as it goes through a qualified intermediary, it's considered a trade, even though it isn't in reality. So they're just somebody that's a transfer agent. At closing, let's say you sell a property for $1 million, check does not go to you, it goes to the QI, and they hold it until they receive the instructions on where to send it. And if we instruct them to send it to a couple of DST sponsored properties, then they will send it to them, and then that would satisfy the requirements of a 1031 exchange.
Beautiful. So this brought up a question as I was thinking. So when someone's selling the property and they go to the closing, the real estate closing, do they have to tell basically everybody there that they're doing the 1031 exchange to make sure that the money does go to the qualified intermediary?
A requirement of the purchase and sale agreement is that there's a provision, just a paragraph, and it's usually standard in all purchase and sale agreements. So when you're selling your property, there's a standard paragraph that says this may be intended to qualify for Section 1031 treatment. You have to state that in the purchase and sale agreement. And prior to closing, we let the title company, we hire a QI, and we can supply one for anybody listening. You hire the QI, you let them know that you're going to use them. You let the title company know that too, and the realtor, of course, so everybody knows ahead of time that at closing, the money's going to the QI and not into the investor's bank account.
Okay, awesome. Thank you for that. And then only U.S. properties are eligible. So you can't do international properties. That's correct, right?
Yeah, this is a US for US.
1033 exchanges. We won't spend a whole lot of time on that, but I know Section 1033 applies to something called involuntary conversions, and then can be where you receive money from insurance, from fires, hurricanes, national emergencies. Do you see 1033 exchanges often?
I do, eminent domain primarily. And what that is in Seattle, they're trying to build transit after the fact rail right through the heart of the cities. Well, guess what? They go to one of my clients and said, you know, that real estate you think is worth $6 million, we think it's worth $3 million. So then they go to an attorney and they fight, but you know, my client's going to lose, but they end up getting $4 million, and they had no cost basis. And they're going, well, that stinks. We didn't want to sell it, and we didn't get our fair market value, and they sent us a check. And now what do we do? Now we got to pay. Not only do we not want to sell it, now we got to pay $1 million in income tax for getting this check. I said, no, you don't. You're not subject to the 45 or 180-day rules. You have a couple years. And so you've been sitting on that check for 6 months, and you found me. We talked. We did DSTs with the $4 million, and they saved the close to $1 million of income tax they would have otherwise had to pay. So a lot of areas, including I believe your own, they're building new highways because the economy was just going gangbusters. They're taking people's property to build, you know, roads, highways, that kind of thing. So a lot of people, you know, when they do a road or a rail line, just think of how many thousands of people would love to know that they could get their proceeds and reinvest it into a DST using what's called a 1033 exchange.
Wow. So go back to that example. Let's say they had no cost basis. They get 4 million. They owe $1 million in tax, and then they go put it in a CD and making 1%. Versus if they put that 4 million in a DST, they still owe property. They still have 4 million because they didn't pay taxes. They make anywhere roughly with 4 and 6%, maybe a little more, maybe a little less. And then when they die, their family steps up and gets the full 4 million and pays no tax.
Yeah, that's pretty much it. $200,000 a year cash flow versus, in your example, $30,000 a year, and $1 million more to leave to your heirs. Pretty easy one there, huh?
Unbelievable. So let's go over a DSC. History of DSCs. How long have DSCs been around?
2004, Revenue Ruling 2004-86 created the DST.
Wow. When it came out, what were your initial thoughts and feelings about it?
When it came out, I was not a big fan of what was being offered in the private non-traded REITs, limited partnerships, all that stuff. I go back to the 80s when I was a CPA. I was looking at these limited partnerships, and they were horrific. People are out there doing real estate deals and selling them and all that stuff. But when you dug down, the commissions were 30-40%. And I was thinking, who would do this? And sure enough, none of them were any good, really. So some people listening may go, I don't want to do something like that because, a bunch of crooks that are putting these out there. And I would agree with you back then it was. And I was not impressed by what I would see as far as the fee structure and all that stuff. So I didn't have any real estate in my investment portfolios like this during that time. Well, then 2008 happened, and it really weeded out the sponsors, and only the best ones survived. And in the last, I'd say 5-6 years, the industry has had a huge change to low internal fees, low acquisition, low distribution fees, trying to be really competitive so that even someone like me could look at it and go, well, now this makes sense. So it's only been about the last 5 years that I felt like public traded REITs and private non-traded REITs and DSTs were worth getting into because they solved some of those issues. The big companies got into it. They had exit strategies and proper real estate and proper research and all of that. So I've been doing it since then, but not early on.
Okay, awesome. And who can invest in a DST?
That's the accredited investor. You have $1 million net worth outside your principal residence is primarily who I end up talking to. And you're selling an investment piece of real estate with a high gain. So those folks.
Okay. DSTs are fractional ownerships, and the underlying investment can increase or decrease in value. So when you're talking about fractional ownerships, how would you explain that to somebody who's basically been the sole owner of their own investment property their whole investment career?
Yeah, let's say you sold $1 million piece of property and we put you into 3 different DSTs, and one of them owned a couple of apartment buildings in San Antonio and Dallas, and one of them owned 20 net lease Walgreens, Dollar General, Advanced Auto Parts stores, and another one maybe owned an industrial park, long-term lease. Well, obviously you didn't buy those 4 properties 100%. You're a percentage owner in each of them. So you're a fractional owner, and you can diversify your investments. You can sell one and buy multiple ones, which is another way that you can improve your diversity. But when, these are real estate. So real estate can go up in value. Real estate can go down in value. So it is real estate. So we got to pick good real estate to get into.
And then do you need a professional to invest in a DST?
Yes, you have to go through a licensed financial advisor. You can't buy one on your own.
I found that very interesting. So you do have to be a licensed advisor. But see, the licensed advisor needs the realtor, needs the real estate attorney, needs the client who owns the investment real estate. It's all a package. So that's what's beautiful to me is for the realtors who know that they've got clients that got these gains that don't want to sell because, like you said, they're trading. One, they don't want to sell from a tax standpoint, but then if they're in a time crunch for the 45-day window to identify a new property to exchange that gain into. But then, like you said, they're changing one problem for another.
Right.
So the licensed investor or investment advisor helps with the DSTs. And are DSTs legal in every state?
Yes, yes, an IRS classification. I will mention on the licensed advisor, there's good ones and not so good ones. And that's a big differentiator there because the reason people haven't heard about DSTs is it's hard. You got to understand the tax implications. You got to be a licensed advisor, and you have to understand real estate inside out and sideways, and cap rates and how it's going to react to different markets, and read prospectuses and all that good stuff. So it takes CFAs and CFPs to help get this thing right. If you're just going to someone who's a salesperson, they may not put you in the best one. They may put you in one that pays them a commission or whatever.
Yes, sir. And that's why it's awesome to be able to partner with you at Madrona Financial, who's been in the business a long time, who started out as a CPA, who knows enough about taxes, but then also dabbled with the real estate from the people that you know and things, and really vet these sponsors. And what's the typical duration of a DST investment?
They usually sell between years 4 and 10, never beyond 10. And let's say you got 3 different ones. One might sell in year 4, one in year 6, one in year 8. And then typically people just keep doing DSTs. They'll just sell one, get into another so they can keep deferring, so they can potentially permanently eliminate all capital gains and depreciation recapture tax.
Awesome. The swap until you drop.
Swap till you drop.
And then can plain Jane cash be used to invest in DSTs?
Yes, it can.
Okay, I find that that interesting too. So you don't have to have investment real estate. That's where it's typically the niche is for the person who's tired of being a landlord, still wants to maintain real estate, rental income, has to defer the gains. But if you just got cash just sitting around, you don't need it liquid, you want some solid income and own some diversified real estate portfolios, could be a good option for you. And then DST sponsors can offer multiple multifamily, senior, student housing, net lease, retail, industrial, self-storage, medical buildings, and hotels. Do you find a lot of the DST sponsors offer multiple things, or do you find that they have their own niche that they typically go towards?
They usually have their own niche that they typically go to. The one that offers all different ones is the biggest one in the world, Inland. In fact, they've asked me to be on their think tank coming out of coronavirus as to what kinds of real estate we should be putting together for future DSTs. So I'm going to join that committee of theirs, and I have some very strong opinions on the opportunities there. I think industrial park leases like Amazon, we've seen what internet shopping has done. I think there's going to be some real good opportunities from essentially motivated sellers that have to sell because of problems. They were too skinny on their equity, kind of like post 2008, where you could buy apartment buildings at a fraction of their fair market value. I think there's going to be some opportunity there. So these are the things I'm going to input with them.
Wow. So for somebody who's never owned real estate before in their life, if they are the accredited investor, and let's say they got $1 million in the bank that they don't want to put in the stock market because the volatility like that, and they want to own real estate, but don't know enough to get into and do it themselves, they can literally own multifamily apartments through a DSC.
Yeah, they can have that. And, one of the ones, the net lease retail, I was doing a live webinar 2 days ago with the CEO and founder of that company. They've purchased 675 properties, all investment grade, corporate guaranteed, long-term, triple net leases. They have yet to have a late rent payment in their history. Wow. So through coronavirus, that's a pretty nice thing to be able to say.
That's exceptional. So tell us, who is Madrona Financial?
Yeah, I was working as a CPA. Of course, I came to work for Bauer Evans 29 years ago. It was Bob and me to start. I eventually bought him out, but he still works there. But I had some clients that wanted me to invest their money. I said, no can do. And they said, why not? And I said, well, I'm not licensed. They said, well, Brian, get licensed. So I did. And then that kind of took over my life. And then I stopped doing billable hours on the CPA side. I still own the CPA firm. So I created Madrona Financial at my desk. Madrona is named after a tree indigenous to growing near salt water in the Pacific Northwest. So that's what a Madrona is. But I started Madrona Financial, and then it grew to what it is now today. So now I own both companies, like I said, about 25 employees.
Wow, that's amazing. So, see, you got it all this time because it's raining all the time. You're just coming up with owning businesses.
Yep, I'm another one of those nerds I was talking about. I can pretty much guarantee anybody who's sat through this webinar so far will agree with me that I am a nerd.
Well, that's a good thing. I personally want a nerd who knows a lot about taxes and real estate with money. And I'm a self-proclaimed nerd as well. What types of properties are commonly offered, would you say, and where are they typically located?
Yeah, any more of the properties are typically going to be in the Sunbelt states. A lot of them are in Texas and Florida because they also have no income tax in those states. But they want to go where the demographics are positive going forward. You're not going to see a DST in New York or Seattle or LA or San Francisco, where the cap rates are terrible, the rents are terrible, the politics. I have my opinions about that. They're kind of anti-landlord. That it's just not a good place. It's been a great place to own it. I mean, your price has gone way up, but now the timing is such that it's a great time to be selling in those areas and buying in other growth areas. For instance, where you live, would be considered a growth area. It would not shock me to see a DST come out, a mile from wherever your offices are, because you're in a growth area. So that's typically where they're going.
Yeah, we've seen some beautiful multifamilies built up in the past few months, some beautiful places here. So basically, what you're saying is if you own property in New York or Maine or Pennsylvania or wherever, you can sell those properties, capture those deferral gains by putting them in a DSC, and then own property in a DSC in Florida?
Yeah, I think diversification is a big thing, especially up here, like I mentioned with the Seattle market. You got some rundown, tear down house that's worth $800,000 because of its postage stamp lot. And you think about selling that to buying, Texas, Florida, multiple kinds of real estate in multiple markets. Sounds like a better idea than waiting for in Seattle, they're going to do rent control. They already taken away your ability to screen tenants. They've taken away your ability to evict them for non-payment. There's a lot of things going on that aren't very good for landlords.
Wow. How many DST properties are typically available? Let's say I go through the process. I love what I'm hearing, the DSTs. I'm tired of being a landlord. I want to diversify my property. I want solid income from it. And boom, I list my property and then sell. How many DST options do I typically have available?
Yeah, I got my list right over here. There's usually about 6 to 12 at any given time. I get weekly updates from my staff person assigned full time to getting me all of that, keeping up on what's coming out and what is out. But about 6 to 12 that we vetted that we'd like the sponsor and the property. Of that, I've got my favorites, and I will recommend what those are in any relationship that comes out through you guys. I will make recommendations, but of course, it's up to the client to make the final determination. And so you can do, the minimum's $100,000. So if you sold $1 million property, you literally could do 10 different ones. However, I would suggest probably a heavier weight to my one that's never missed a rent payment. Maybe diversify to some apartments or other kinds of real estate that you like. But I would probably say generally on like $1 million one, I might do 3 to 4 different DSTs.
Okay, beautiful. Love diversification. And explain briefly how is debt replaced on existing property?
Yeah, so if you have $1 million property, but you owe $400,000 on it, you net $600,000 at closing. And if you go out and try and buy a property on a 1031 exchange, it's not a $600,000 property you got to buy. It's $1 million property. because you got to replace your sales price. So you got to go out and get a loan. I had a conversation with this one guy. He was selling an apartment. He said, I was looking at properties, but mine worth $7 million and I owe $3 million. And even if I found a really good $7 million property within 45 days and negotiated the purchase, agreed on it, had inspected and liked it, then I got to take my $4 million and go to the bank and ask for a $3 million loan. My wife and I are 80 years old. So I don't think I'm going to be asking them for a 30-year loan when we're already 80 years old. So, so they had to replace their debt. So with most of the DSTs, they already have about 50% leverage. So when he took his $4 million and bought a whole bunch of different DSTs, which we did, they each had about 50% leverage. So he was actually buying $8 million worth of property. It's non-recourse debt to him, so he's not responsible for it in the end, other than just repayment from the properties. It's non-recourse, but it does count towards the 1031 exchange. So he needed to buy $7 million of property. He bought $8 essentially because of his share of the debt.
Wow, to me that's a big deal, because a lot of people do have debts on and mortgages on their investment real estate, and they want to get these gains, but that's a big deal that you have to literally replace the sales price on the new property within 45 days. Dude, I'm stressed out thinking about that.
Yeah, so was he.
Yeah, let alone if I'm turning 65 plus years old. Wow. So a DST really solves a lot of problems. And then are some properties more recession proof than others?
Absolutely. As I mentioned, the one that hasn't missed a rent payments, because all they do is buy buildings that are called necessity-based retail. So if you think about Dollar Generals and other dollar stores, their sales go way up in a recession. So do auto parts stores and plasma centers and discount grocers, drugstores, their sales stay the same. And that is what their portfolio is. It was designed for a recessionary market. So not only does it not lose value, it probably actually would go up in value. So I call that more recession proof. If you buy a Class A plus apartment versus a Class B with a value add, I won't get too nerdy here, but I certainly think there can be some value add properties out there. Anything with an Amazon long-term lease, I'd say that's pretty recession proof. We're seeing that through coronavirus. I'd be pretty nervous about buying a hotel DST, obviously, and maybe even a student housing DST right now.
Right. I'll get a little nerdy with you. So would you say that with Class A properties, typically your real good properties, you may have some more solid and more reliable income, but maybe with a Class B or even Class C properties, you get a little higher income with more risk potential or more risk exposure, but more potential appreciation?
Yeah, it can be. However, the Class B that I like to use, there's a particular DST sponsor that puts $10,000 per door aside in reserves up front. And every time someone moves out, they upgrade to wood floors, granite countertops, stainless steel appliances, and raise the rents 20 to 25%. So they have a built-in value add proposition, which I believe will increase the value of the property much more than the $10,000 per unit. And when people are pinched in a recession in a Class A apartment, they might move to this one that looks almost as nice, but it's cheaper to rent.
Wow. Okay. Do any DSCs offer C-class properties that you recommend?
I have seen C-class properties. I didn't like them. I had one person come to me, offer me a DST. I remember it. I wouldn't have lived in it when I was poor and in college. It was in Waco, Texas. It was built in the 70s. It looked terrible. It was a teardown. And yeah, the cash flow was okay in the moment, but I wouldn't want to own that 5 years from now. So I said, thanks, but no thanks.
Okay, good. It's nice to know the people looking behind the properties they'll be recommending would purchase it themselves. I definitely like that. So options at DSC maturities, let's run through these. I know you mentioned that most people just swap until you drop and exchange into other DSTs, which the financial advisor guides you through the whole new selection with Berry Financial, partnering with Madrona Financial. The step up in basis opportunity remains. That means anytime you die, if you've got substantial gains, it goes to your heirs with the step up in basis. You can exchange into actively managed real estate. I want to spend a second on this. So do you find, of course, most people do the swap until you drop, but that sometimes they just got a lot going on with their lives. They want to get out of their current property. They sell it, put it in a DST. 4, 5, 6 years later, the DST comes to maturity. The potential investors at a better spot, and they'll go back and actually actively manage their real estate again.
I don't see it often, but we could see it post-coronavirus. Let's say that you got into a DST and you're coming out and you go, you know, there's some real good opportunities where I live because prices dropped due to this, and I want to buy low. So I could see that, but I think most people, it's kind of like once you've hired someone to clean up your house, you never go back to cleaning your own toilets. You just say, this is too good. I like this.
Oh,
so
man.
it's kind of like that.
My wife and I are in that situation right now, man. So holy smoke. The heirs collect proceeds and step up basis eliminates income taxes. How beautiful are those last 3 words? Eliminates income taxes. And then you can collect proceeds and pay income taxes. So at a DST maturity, let's say you've held a DST, you deferred the taxes, 5 or 6 years later, it matures. So you can literally collect the monies, pay your taxes, and basically put that monies in CDs or wherever else you want. Is that right?
Yeah. If you decided, and you know, who knows, maybe you have a loss from something and you go, well, I got a DST coming due. I'll offset the gain against the loss. I won't pay any income tax, and I'll buy an annuity from Berry Financial, whatever it is. You know, depends on where you're at in life as to whether something makes sense to sometimes pay tax. If the rates are really low for a particular reason in a given year and the timing's right, that could happen. Yeah.
Okay, awesome. So very flexible. So as we bring up to a summary, it's been a very quick 47 minutes so far right now. A DST can be used in a Section 1031 tax deferred exchange. DSTs offer better diversification, cash flow, potential appreciation, income tax advantages, and eliminate those landlord responsibilities with the tenants, termites, and toilets. And what did you say the 3, those are the 3 terrible T's. What are the 3 good T's?
Oh, I don't even remember. I've
Wow, yeah, a lot of good stuff right there. So heirs can inherit DST proceeds income tax free, and only your financial professional can access DST. So Brian, when talk about why a little bit why most people haven't heard about DSTs. Oh, I think you got muted right there. Let me unmute you real quick. No, it looks like we lost the volume for a moment. There we go. There we go.
back.
Yeah, we're back. We're back.
All right. The new normal.
The new normal. Yeah. So why do not many people know about DSTs? Oh, I think you muted yourself again. Okay. There we go.
As mentioned earlier, you got to be a financial professional. You better understand income taxes, and you better know about real estate inside out and sideways. I've met one of me. So
Yeah.
there's just not a lot of people with that. You'll be the second.
Okay, cool. Yeah, not many people know. Investment advisors know about taxes and real estate. Section 1031 exchanges are complex. You got to have a realtor to sell it. You got to have clients that typically have the gains or other things, but a lot of papers and rules have to be right in place to get by the IRS to defer taxes. So anything worth having is typically hard work. No doubt about it, but we streamline it as much as we possibly can. DSTs offer an incredible exit strategy for owners of appreciated investment real estate when they're looking at getting back more time in retirement. So we serve 3,000 clients. Our average age client is 65. The Myrtle Beach area is retirement mecca. So there's great opportunities for realtors to get out there and sell these clients' positions, get them the best price that they can get, and then really get them out of landlord abilities with being able to defer those taxes. No doubt about it, some of the best options that you can have. And Brian, you said you were teased not too long ago about some clients that have maybe $17 million of investment real estate they're looking at doing DSTs with.
Yeah, I got that email last night from actually the founder of the firm and one of my staff CPA advisors. And so I emailed her right back and said, give me a call. She said, no, I'm going out to dinner. So I felt like I was teased there. I have done a $35 million DST for someone. We were able to convert that into a premium finance fixed index universal life within an irrevocable life insurance trust with annual gifting and on and on. We bought an interest rate ceiling, and now I'm nerding out. But it was wonderful. We're going to be able to transfer, not only get out of the $6 million of tax he would owe, we doubled his cash flow from $900,000 a year to $1.8 million. We took some of that excess cash flow and create tens of millions of estate and income tax free money for his legacy plan. It was beautiful.
Wow. So sold 30-something million of DST things, increases cash flow 100%, really, and then put that 100% excess into positions that gave his family 8 digits. That's 8 digits, tens of millions of dollars tax-free to their family with that. So this has been a pleasure. It's been amazing having Brian Evans on here. If you're interested in DSTs and you're interested in some of the things that we provide, and you are you're that person who knows somebody, or you are somebody who has that real estate, you're looking at capturing those gains, the DSTs with the diversification, the lack of being a landlord, the potential appreciation and higher cash flow, then go to barryfg.com/schedule meeting. That's barryfg.com/schedule meeting. Barry Financial has been giving retirees and pre-retirees peace of mind through safety since 1987. Brian Evans is exceptional. I've heard you the first time probably 3 years ago, I think, and I knew you were that nerd way back then. But I absolutely loved it. You're at the top of the field. It's been a pleasure having you on here. Any final words, Brian?
No, I was fun to do this with you. I think, definitely reach out if you listen to this. And even if it's not you, but a lot of real estate people know other real estate people. And so imagine how you can be helpful to your friends, acquaintances that have real estate but haven't heard about this. It sure be a service to them. It's really life-changing for a lot of people I've been working with, that they finally can retire for real, have better cash flow, and more security with their real estate investments. You can do a real service for someone that wasn't able to attend this.
Awesome, man. Well, hey, listen, thanks again. Stay safe out there in Seattle. And you said it was sunny today, so enjoy the sun out there.
I will. Thanks, Reid.
Hey, thank y'all for watching. God bless.